Indicators were all the rage a few years ago. Not so much now. Why?
Well, actually, it's even more interesting than that. I think you look at these spread betting platforms, and they've got I would say dozens, or I was going to say hundreds of indicators on them, but actually got dozens of indicators on there. So they are still there. But I have to admit that I myself only use basically the RSI. That's the only one I use because I've used it for 25 years. I'm familiar with it. It's 14-day RSI. You see the same thing again and again, the divergence, the resistance lines that you can draw in there, very, very basic stuff. But I think that for a long time, people were looking for the holy grail indicator, the one that would solve all their problems and get it right for them. And obviously it doesn't exist. And so possibly there's been sort of a fatigue in terms of producing or using new indicators, but there are actually new indicators coming in all the time, which is add to the pile of these sort of these technical instruments, which most people don't really know how to use or understand on what basis they are actually derived.
Okay. I mean, are there a series of the most most important, most useful technical indicators that you want to share?
I think for me, really, it's actually the price action and the price patterns which seem to be the best thing. Then I use moving averages underneath that, and then as I said, the RSI indicator. The initial pattern, the initial trend, obviously, which is what people try to determine. That is not as easy as it sounds, because normally by the time you've found a trend or you see a trend, it tends to it tends to break down. So you're late to the party. I do like just rebounds off moving averages, the 200-day, the 50-day, the 20-day. That tends to be very useful because you can go long or go short at those points and with a relatively tight stop loss. Really, within the price patterns, going back to that, I think probably flag formations are actually the most also very useful. So they're basically there's been a move to the upside, there's a consolidation of a third of that move, and then you wait for the next break in that flag. And it's just a good risk-reward type of place to be. Normally you have two stages to any move to the upside or the downside. So you identify the mid-move consolidation, and then you go with the flow in that way. So I think there are relatively simple, relatively basic, and quite effective sort of features that you can use in charting. And I would say that it's probably in the order of the price action or the price pattern, moving averages, and then the oscillator.
You answered the second question there, which was which indicators work best for you and why.
Yeah, I think the issue really is to find one indicator, stick to it, get to know it very well. It doesn't really matter whether it's the MACD, the RSI, or ROC, or anything else. It's just getting familiar with it as you would get familiar with the personality of somebody you know.